Welcome to This Explainer. Today, we're taking the source math and using it to totally dismantle that financial anxiety keeping you awake at night. We're going to prove that a standing start is absolutely not a disqualification. If you feel behind, well, this is exactly where you need to be. We're going to look past the societal pressure and dive directly into the numbers.
So I want you to imagine for a second that it's 2 in the morning. You're staring at your phone screen with this strange sense of dread, and your thumb is just hovering over your banking app a fraction of a second longer than it really should. You finally click, and there it is. 0. Not a rounding error, not a forgotten account, just 0.
And, when you're 35, that 0 hits entirely differently. It feels less like a balance and way more like a permanent sentence. Society tells us that by this age we should have a house, a solid career, a growing pile of savings. So staring at that empty account feels like a permanent verdict on your entire life. You close the app, put the phone face down, and you literally don't tell a soul. But here's the thing you absolutely need to know. Federal Reserve data reveals the reality here. 1 in 4 working-age Americans has an absolutely empty retirement account. That means you are not some unique cautionary tale. You are commonly stuck, not uniquely broken. And those are two very different things, because one of them can actually be fixed. Which brings us to Section 1, the homeownership wealth illusion, and deconstructing the 40 times gap. Let's dive right into this intense cultural pressure to buy a home and see what the data really tells us. Because a massive part of the $0 anxiety comes from the wealth illusion we've all been sold by our parents, landlords, and the real estate industry. On the surface, the statistics show a staggering wealth gap. The median homeowner has a net worth of around $400,000, while the average renter sits at just over $10,000. That is a 40 times gap. It makes homeownership look like the absolute magic bullet for financial maturity, right? It's the exact number people quote when they tell you renting is just throwing money away. But here is the crucial catch. This gap is largely driven by selection bias. People who buy homes typically tend to be older, have higher incomes, and are already more financially stable to begin with. They were gonna be wealthier anyway. For them, the house basically just acts as a forced savings account. They literally have no choice but to pay that mortgage every month. It accelerates wealth, sure, but it doesn't magically create it out of thin air. Let's move on to Section 2, the brutal math of buying, where we peel back the American dream in 2025. If we strip away the opinions of your landlord and your parents, the math becomes brutal incredibly quickly. Right now, the average monthly mortgage on a median-priced home is nearly $800 more expensive than the average rent. That's $800 more every single month, just for the base payment. And honestly, most buyers focus entirely on that base mortgage payment and completely ignore the staggering hidden costs. We're talking property taxes, insurance, HOA fees, and those awful $15,000 HVAC replacements. All of that adds an average of over $21,000 a year to the bill. Plus, if you buy before you're financially ready, or you have to sell before the 5-year mark, closing costs and transaction fees can actually destroy your wealth instead of building it. This reality really sets in during the first year of a modern 30-year mortgage. If your payment is around $2,200 a month, over $1,900 of that goes straight to the bank as interest. You're building almost zero equity, like $287. For those first few years, you aren't building a massive asset. You are essentially just renting money from the bank at a very high price. Which leads us to Section 3, the renter's secret weapon. Jake versus Marcus. This comparison absolutely dismantles the myth that renting is simply throwing money away. Let's compare Jake, the stressed landlord, to Marcus, the passive investor. Jake buys a property and spends hundreds of hours dealing with leaking roofs, terrible tenants, and property taxes. Marcus stays a renter, but he takes that monthly rent difference, that $800, and drops it into a basic index fund every month. Over 20 years, Marcus's money grows in a curve that becomes absolutely astonishing, yielding a highly competitive net worth with zero midnight repair calls. You see, the stock market doesn't require you to take on hundreds of thousands of dollars in debt or take on a part-time job as a landlord just to see a return. The real tragedy isn't that renters are throwing money away. The actual trap is simply renting while choosing not to aggressively invest the difference. That is the only move that makes renting a long-term failure. Now for Section 4, your biggest expense, time debt, the cost of the years you literally cannot recover. The most expensive thing you can own right now isn't a house or a fancy car, it's time debt. It's the massive debt you are accumulating by waiting to start. Tracking a standard $500 monthly investment, starting at age 25, creates a vastly different retirement outcome than waiting until you're 35 to make that exact same move. To put that into perspective, that 10-year delay from 25 to 35 literally costs you $700,000 in compound growth by the time you reach retirement age. That is the true invoice for waiting, not as a punishment, just as pure math. Now, knowing this creates a heavy paralysis that feels a lot like procrastination, but it's actually a form of grief for the version of your financial life that didn't happen. You're mourning that your 23-year-old self wasn't more disciplined. But you absolutely have to stop letting the shame of your past decisions dictate the massive potential of your future runway. That past version of you doesn't exist anymore. You do. Which brings us to our final part, Section 5, Break the Silence Today, Naming the Problem and Building Past It. Being 35 with zero savings is not a disqualification. Let me say that again. It is not a disqualification. It is a profound wake-up call that gives you a reason to move that a 20-year-old simply doesn't have. So here is the exact formula to start moving today. First, plug the leak with a $1,000 cash buffer so a flat tire doesn't turn into credit card debt. Second, strictly automate your saving system so you remove willpower from the equation completely. Make the money move before you even see it. And third, immediately capture your employer match and aggressively use your tax-advantaged accounts. Let's look at the hard math to prove this isn't over. From a complete standing start at 35, earning a median income of $75,000, if you simply redirect 15% of that into index funds, you mathematically build over $1.1 million by retirement. The destination isn't close to you. The runway is just a bit shorter. Building real wealth requires looking past the social proof of a house key or a fancy car and understanding that the math of your life is the only thing that actually matters. Whether you buy or rent, the trap is picking a path based on a headline instead of running the numbers. You just have to decide today to stop putting that phone face down and name the problem. If you're ready to break the silence and use hard math to finally build past zero, the only question left is, will today be the exact day that number starts to move? Thank you for checking out this explainer, and remember, the most important step is the one you take right now.